Hello and welcome to CMS Forex News. I'm market analyst Nick Nassad. Today is Thursday, March 5th, 2009. The Aussie Yen pair slid more than 200 pips from yesterday's high as global equities did an about face and gave up their gains from yesterday's session. That burst what risk appetite there had been and strengthened currencies like the yen and dollar as safe havens. In the UK, average house prices declined by 2.3% in February. That more than offsets January's 2% gain. On the year, prices are down 17.7%. Just as in the US, key measures of housing affordability are on the rise, with levels in the UK at 6-year highs. Still, as the report states, continuing pressures on incomes, rising unemployment, and the troubles in financial markets, which has limited mortgage lending, will likely mean that 2009 will be another difficult year for the housing market. More importantly, the Bank of England lowered rates by 50 basis points to a fresh record low of 0.5%. This move was expected by economists. It also said it will undertake a program of asset purchases of £75 billion financed by the issuance of central bank reserves. With the interest rate at historically low levels, the bank feels the need to undertake quantitative easing in order to shore up its financial sector. With stocks reeling in Europe and the Bank of England sounding dovish in their meeting today, the pound-yen pair tumbled 300 pips off its intraday high set in the Asian session. That high, near 141.50, tested the highs from last week and sets up a clear line of resistance going forward. In the Eurozone, the European Central Bank cut rates to 1.5% as expected, which is a new record low for the central bank. The economy is facing the worst recession since World War II, and incoming data shows that the recession is deepening. The services and manufacturing sectors contracted at a record pace in February. Confidence among consumers is at an all-time low. Inflation is at its weakest since 1999, and firms are laying off more workers as revenue drops as a result of weak economic activity. German retail sales fell in January by 0.6% on the month, and 1.3% in annual terms. Economists had expected an increase for the monthly figure, so the news was disappointing. Consumers cut back on spending as they see unemployment rising and are concerned about the labor market. The euro-dollar pair began sliding overnight after reaching the 1.2660 area following yesterday's bout of risk appetite. Today, the pair fell 170 pips from that high to the 1.2480 level, which was slightly higher than yesterday's low. The pair found some support then, and price action turned sideways the rest of the New York session. The euro declined heavily against the Swiss franc, breaking below a line of support that goes back to January 17th. We have been in a consolidation pattern the last couple of weeks, though the euro was weakening, but today's break of support can lead to further losses for the euro, as the ECB is the only central bank with room left to cut rates. In the U.S., there were 639,000 Americans filing for initial jobless claims during the last week of February, as companies continue to cut costs by shedding payroll. It's the fifth straight month that claims have been above 600,000, though there was a reduction compared to the previous week. The number of people continuing to collect benefits for more than 1 week hovered around 5.1 million. U.S. factory orders declined for a record sixth straight month in January, falling 1.9% on the month. The headline figure did show a smaller than expected decline and compares to a downwardly revised 4.9% for the December period. The US dollar-Canadian dollar pair, which fell as low as 1.2725 to start the session, rose in favor of the greenback today. Stocks in the US gave up their gains from yesterday, and risk aversion helped push the pair up 160 pips to 1.2910. Today's low turns an old resistance level into a level of support. Overnight, both Germany and the UK released their producer prices, while tomorrow, the US will post its non-farm payroll report. And that concludes our broadcast. Thank you for joining us here at CMSFX.com, and happy trading.